So when we're buying options, we have many different choices to choose from. Taking a look at this stock, Movado, you can see it's trading at $37.52 at the moment. It had a recent sell-off from about $45 down to $36. So it's on sale. You can see the last time it was at this price level, there was a lot of demand for it. Twice before, matter of fact. We can see that the implied volatility of the options has been reduced, meaning the premiums have been reduced. So the options are on sale, the stock is on sale. This indicates a good time to buy a call option, as call options increase in value when the security increases in value. Now when we're buying an option, we tend to want to buy longer term options with more time in them so that the stock has more time to move in our desired direction. You can see this one expiring on the third Friday of December 2014, which is 107 days away. We can see the strike prices listed here from 22.5 up to 60. And we see the prices from 35 cents to 15.80. So the question is, when we want to buy a call option, which one of these do we buy? A lot of newcomers to options trading tend to gravitate towards these cheap, out-of-the-money options because they're cheaper. And a lot of people have this Walmart mentality, and they like to buy cheap things. Well, don't ever forget that you get what you pay for, and this is true in the options industry. If you want to see the probability of it expiring in the money, you can take a look at the delta column, and for this 55 strike call option, it's trading at 40 cents, it has just under a 6% chance of finishing in the money. If we want to analyze this call option, we can take a look and see the details. My default is set to buy 10. The strike price of 55 we picked at 40 cents. The break even is going to be adding those together to 55.40. Stock is currently at $37.50, so it's gone from $37.50 all the way up to past $55 by expiration to make profits. You can see the probability for maximum loss is 98.79%. Most likely you're going to lose this premium because within 107 days it's most likely not going to go up past $55. And an interesting point I'd like to point out is that if the buyer of the option has a likelihood of 98% to lose the premium, that means that the seller of the option has a 98% probability to keep the premium. So we'll hit sell and we'll analyze this one. And you can see at 20 cents, the max probability for maximum profit is 98.8%. It's the same probability because if it's going to be the probability to move up profit for the buyer, it's going to be the same probability to move up before it starts making losses for the seller. And the 20 cents is the difference between the buy and the asking price for here. So if you get a market maker to accept this offer, which would be doubtful at this point, but you can see this is the options you want to sell, not necessarily buy. Options that we want to buy are more expensive, and what we pay in price we get probability. You can see that this $25 strike call option is trading at $13.40. That's a lot more than just 40 cents. In fact, it's $13 more. That's because of all the intrinsic value. The difference between $25 and $37.50 is $12.50. So this would have to be more than $12.50 because that's the intrinsic value of the option. The difference is the time value. Again, in the delta column, we see that this one has a 93.59% chance of expiring in the money. Again, because of all the intrinsic value. Taking a look and analyzing this call option, we will see the probability for maximum loss to be much, much lower than 98%. In fact, it's less than 1%. The reason this is so low of a probability for maximum loss is because the stock would have to decrease in price all the way down to 25, which is the strike of the call option we purchased, in order to produce the maximum loss. And we found on the price chart that it's at an area of high demand right now at the 37 price area, and most likely it's going to increase. Again, to find the break-even price, we take the strike price of the call option plus the premium paid and make 38.40. There it is, 40, which is a lot closer to the current price of 37.50. So it's got to move up about 90 cents for it to start making profits. That's a lot better deal than having to move more than $15 up in price, before it can start making profits by expiration. So that's the difference between buying a more expensive call option and a less expensive one. So again, what we pay in price, we gain in probability of profit, as indicated by this delta column. So if you'd like to know more about trading options and mastering the skill of options trading, please sign up for our online option income training program, and we'd be happy to help you. Thank you.